Dr. Halimah, that our departments, alhamdulillah, has been intensively conducting the guest lecture series since last 2 years. So we are combining the offline and online mode of the teaching activities, whereby the lectures, every lectures in each or respective courses, they have to have the partners from the international university, and then conducting some collaborative teaching program that we have today, and it will be done reciprocally. So hopefully this one is the way how we try to expose the lectures experience and then as well as the student experience. And given that in our university, in our program from Department of Economics, we have two kind of programs. One of the program is international programs. So and here we are from regular program, even though they are regular program, not English as the medium of instructions, but they have to expose themselves to the international activities. So today, because of I'm teaching more than 10 classes, doctors, and more than 5 courses in a semester, so this class actually is the central bank class. So I was teaching monetary economics, central banking, managerial economics, and then also international financial system. So this class, just one class that I teach for this semester on Friday exactly, 7 a.m. until 8:30 p.m. EM in the morning. And today, dear brothers and sisters, we are blessed to have our guest lectures from University Mara, Malaysia, Dr. Halimah. So she will be discussing with you all about the monetary framework, monetary policy framework, either Malaysian perspective or maybe general perspective, whereby given that this months, these weeks, if you open your LMS, your My Class, we will be discussing on the monetary policy frameworks. So her discussion perhaps will be touching down this kind of issues. And given also, if you students, you remember that some set of banks around the world right now are trying to increase the interest rate. Just recently, Central Bank of Indonesia just increased 50 basis points the interest rate from in the in earlier year 3.5%, but now has been 5.25%, has been increased more than 2%. As well as in US, has been increased 5 times since the early of January. So these facts that the monetary conditions try to accommodate and react with the existing situation whereby the global economy are uncertain, so that some central bank tries to interact and respond by tightening monetary policy so that the inflation rate, whereby the purpose of the monetary policy can be retained in the position whereby the purchasing power still maintained and then the financial stability still can be maintained as well. So with that, I will not be long giving you the introduction, because here we have Dr. Halimah with you. And then please don't hesitate to interact or interrupt if in case that you have any questions or maybe any feedbacks during her discussions. With that, Dr. Halimah, I pass to you. We will start. We will end around maybe maximum, doctors 9:30 p.m. Malaysia. But if you feel that you can just finish before that, is up to you, doctors. So
Dr.
please, time
Dimas.
is yours, Dr. Halimah.
All right, thank you so much, Dr. Dimas. Okay, Assalamualaikum and very good morning to everyone. I think not many of you, about 20, I mean, maybe about 19 or 20 students only in a group.
We have 30 student doctors actually.
Oh, okay. Maybe still, they're still sleeping.
Yeah.
Okay. All right. I'll share my slide regarding this monetary policy. Okay. Right. Let me share my slide first. How to share the slide here actually? I very seldom
you can
actually
just
use
click the
this
share
Zoom.
screen, doctors. Share
Huh?
screen. The share
Share
screen,
screen where?
the
At
green
which
one.
part?
The green one in the Zoom.
The
The share
green
screen,
one
the green one in the center.
in the
Nearby the
center.
chat. Nearby the chat button.
Chat button. After chat button, I have pause stop recording. I have participant, breakout rooms, and also reaction.
Because you have been a co-host here. Okay, let me share this one first.
Maybe at setting, is it? No.
Share screen, doctors.
Share screen where?
Nearby the pause and stop recording.
Pause and stop. I have chat, then beside that I have pause and stop recording. I don't have anything to be shared here.
Okay then. Okay, can you share to me the slide? Then I can help you then, doctors.
Sharing you the slide. Okay.
Yeah.
Right. Wait. Can share you or not?
Share to the chat, perhaps, doctors.
Yeah. Through the
Make
chat.
it easy.
You mean in
Yes, through the chat.
this Zoom? Is it?
Yeah, Zoom chat. Yeah, personal, doctor. Personal chat. Yeah.
Personal chat. Chat. Okay.
Yeah.
Wait, I have show chat previews. How come I don't have this one?
The
Show
chat.
chat previews, but when I click chat, okay, I can click the chat, then
Yeah.
share here. How to
Yeah.
attach the file?
This one is
Okay.
the bottom one nearby the
Everyone and everyone directly. Because I'm using the tab, you see, that's why maybe quite
the
difficult right here.
tabs. Yeah.
So
Yeah,
normally
perhaps.
tab cannot attach anything, is it?
Okay. Can you send to my WhatsApp then, doctors? No, never mind.
If let's say cannot WhatsApp, I send to your email, Dr. Dimas?
Okay. That's good, doctors.
Okay. This one. Okay.
Through email, doctors?
Yeah, I'm
Okay.
attaching the files. Okay,
Okay.
to selected. Now, what will I do? Done. Okay. Sending. Okay, done.
Okay, still process, doctors here.
All right.
Okay. Yeah. Okay. Receive. Yes, doctor. Can you see yours?
Okay.
Yes, please, doctors.
Um, okay. So I think another slide. Can you open another slide?
Oh,
Not
how
this
many
one, not
slides?
this file, another file.
Oh,
I
not this
sent two
one.
files actually. This one
Okay.
later. This one later. I'm
Okay. You
going to
have two
cover the
slides.
first part.
Okay. Okay. Yeah.
Okay. So, all right. Okay. All right. So today I'm going to cover about monetary policy. All right. So for learning objectives, there are many. Okay, in which the first part, you are going to see the types of monetary policy. Before that, I will define what does it means by monetary policy. All right, and then under types of monetary policy, actually we are having two types: expansionary and also contractionary. Okay, so both actually, one of it actually will apply during inflation, and also another one during unemployment or even recession. Okay, and then you will learn about monetary policy instruments, or even what we call that as the tools of monetary policy. Okay, and then you are going to learn also monetary policy objective, okay, the instruments, advantages and disadvantages, and also a little bit about functions of central bank. All right, so first of all, okay, this monetary policy, when we talk about monetary policy, the words monetary actually relate to money supply. All right, relates to money supply. So in this particular situation, all right, central bank actually will either increase the money supply or even reduce the money supply. It depends on what kind of problem actually faced by that particular country. All right, maybe during inflation or even maybe during recession, or what we call that as unemployment problem. Okay, so monetary policy actually can be defined as a government policy on money supply and also credit creation aimed at achieving higher economic growth, okay, stability in prices, and also full employment. Okay, so this is actually policy, right, that will be implemented by government. Okay, this government actually will instruct, okay, this kind of policy to be implemented by the central bank. All right. Okay, so maybe we can move into another slide, Doctor. This is the meaning of monetary policy. I already explained just now. All right. So there are actually two types of monetary policy. Okay, the first one, to overcome inflation. So government actually will implement contractionary, or what we call that as restrictive or tight monetary policy. Okay, so this kind of monetary policy is actually a tools, okay, used by the central bank in order to reduce the money supply in the economy. Okay, so what is actually the aim of using this kind of tools? Okay, the aim is actually to reduce the pressure of inflation in an economy. All right, I believe that every one of you know what does it means by inflation. Okay, inflation means increasing in general prices. Okay, in a level of general prices of all goods and services for all goods and services in a country. Okay, for a certain period of time. Okay, and this actually continuous increase, okay, in general price level of all goods and services in a certain country. So we call that as inflation. All right, so during inflation, actually purchasing power of the people will be increased. All right, when purchasing power of the people is increasing, people actually demand more for the goods and services. All right, but actually the supply of goods and services remain constant. That's why this price level of all goods and services start to increase because demand is greater than supply. All right, this is what we call that as inflation. All right, and another tools types of monetary policy. Okay, we call this as expansionary or even cheap, or what we call that as easy monetary policy. So this kind of policy will be implemented in order to overcome unemployment. What we call that, this happened actually during recession. So actually what government will instruct central bank to do? Okay, central bank actually will increase the money supply and also those activities in economy. Actually later on you will see, okay, what kind of tools in order to increase money supply, what kind of tools in order to reduce money supply. There are actually quantitative and also qualitative tools. Later on we'll look into this kind of tools. Okay, so by increasing the money supply, this actually will help, okay, to overcome the problem of unemployment and also will increase the growth of a country's economy. All right. Okay, maybe we can have a look into the next part. All right, this is the tools that I said just now. Okay, general monetary policies instrument, we have two. Okay, we have quantitative and also qualitative. So under quantitative, we have about 5 tools. Under qualitative, we have about 3 tools. Okay, so the 5 tools under quantitative, okay, actually related to the first one, discount rate. Okay, second one, we call that as OMO or open market operations. Okay, the third one is legal reserve requirements. Okay, number 4, interest rate. And the last one, we call this as a funding. All right. Whereas for qualitative, this is actually not in terms of figures. That's why we call that as a qualitative. Okay, we have 3: selective credit control, we have moral suasion, and also special directive. Okay, so let's look into the quantitative tools first. Okay, quantitative tools first. Okay, the first one is actually open market operations. Okay, open market operations. So what does it mean by open market operation? So when we talk about open market operation, it is actually related to open market purchase or even open market sale. So in this case, actually central bank will either buy or sell securities and also treasury bills in the open market to influence the size of the bank deposits. All right. So again, it depends. Okay. Whether actually it happens, okay, during inflation in order to combat inflation or even in order to combat the problem of unemployment. So central bank actually have 2 choices, either to buy or even sell securities and also treasury bills. Okay, so later on, this is generally, I'll talk about open market operation. Later on, we will see into those kind of situation in order to overcome inflation and also in order to overcome recession or even unemployment problem. Okay, which actually central bank will do, which one, buying or even selling securities. Okay, and second tools under quantitative, we call this as a legal reserve requirements. Okay, legal reserve requirements. So under legal reserve requirements, actually you have to know first what does it mean by reserve requirements. Okay, reserve requirement is actually the requirements by the central bank. All right, okay, that all the other financial institutions need to actually reserve, okay, some amount of money in the central bank. So we call that as a reserve requirements. Okay, so in order to apply these kind of tools, in which reserve requirements, again, it depends on what kind of problem, okay, that facing by those countries, okay, whether inflation or even recession. Okay, either actually the central bank can implement by increasing, okay, the percentage rate of reserve requirements or even by reducing the reserve requirements rate. All right. So under this reserve requirement, okay, we have statutory reserve ratio. This is what I mentioned earlier, the amount of reserve required on banks to be kept in the central bank. So there will be a certain percentage. Okay, and then we have also liquidity ratio. So the words liquidity, liquid. Okay, liquid means in bahasa we call that as cair, ya, kecairan. Okay, how fast actually the asset can be converted into cash. That is the meaning of liquid. So this is actually the amount of banks liquid assets required by central bank to be kept in the banks. Okay, and we also have cash ratio, amount of cash that are required to be whole. Okay, so in this particular legal reserve requirements, central bank actually may increase the cash, liquidity, or even statutory reserve ratio requirements to influence the credit creation and also money supply. So if let's say the ratio is higher, this means that lesser amount to be loaned out to the public. Why? Because when higher ratio, okay, of this reserve requirement, meaning to say the banks need to keep actually the amount of reserve more in the central bank. So when they actually kept a higher amount of reserve at central bank, therefore actually lesser amount will be given out of a loan to the public. Okay, so when lesser amount of loan will be given to the public, therefore public or even household, okay, will having actually less. Okay, less cash in hand and so on and so forth. So purchasing power of the people will be reducing as well. So this actually will happen during inflation in order to combat the problem of inflation. All right, that will be number two. All right, and then number three, what do we have? Number three, okay, maybe we can move into the next slide. This what we call that as a discount rate. Okay, the words discount, this is not the discount, the normal discount, okay, that normally you see when you go to shopping complex, okay, some of items, okay, they got certain discount, 10%, 20%, and so on and so forth. But this here, when we talk about discount, this is not that particular discount. This is actually, when we talk about discount rate, we are talking about the interest rate charge. Okay, so this is very special. The word discount rate actually referred to the interest rate charged by the central bank. Okay, when central bank actually giving out loan to the depository institution. So this is actually an interest rate. Okay, but this interest rate being charged by the central bank, okay, to the other depository institutions, when actually depository institution make loans from this particular central bank. Okay, so discount loans, the words discount loans, again, this is actually loans made by the depository institution, for example, like banks or even other financial institution from the central bank. So either actually central bank will increase the discount rate or even reduce the discount rate. Okay, again, it depends on what kind of problem, okay, faced by those countries. Okay, inflation or even recession. All right, so that would be number three. Okay, the third tools under quantitative instrument. And we also have the next one, number four. This is the interest rate, similar like discount rate, but this is actually interest rate charged by the bank, okay, to the public. All right, to the public. So we call this as an interest rate. Again, okay, the depository institution or even the banks can increase the interest rate or even reduce the interest rate. All right, and finally, number five, we have the last tools under quantitative instruments. We call this as a funding. When we talk about funding, we are talking about conversion of short-term loans to long-term loans. Okay, so these short-term loans can be converted to long-term loans as well. All right, so again, it depends on what kind of a problem facing by those countries. So we have actually short-term assets, okay, for example, like treasury bills, okay, and also we have long-term loans as well. All right, so if let's say the short-term loans has been converted to long-term loans, so this actually will lengthen the payment of the principal sum, so that, okay, when the banks actually lengthen the period of time, okay, for the people to make a payment, okay, for their loans, so that actually bank cannot create multiple credits. Okay, so in this case, when they actually cannot create multiple credits, they are actually giving less actually loan to the public. So purchasing power of the people will be reduced and so on and so forth. Okay, so problem of inflation can be solved as well. All right, so that's under quantitative instruments. All right, then what else that we have? Maybe we can have a look. I think we have about general monetary policy under qualitative instruments. This cannot be measured in figures. Okay, so we call this as a qualitative. All right, so we have three, as I mentioned earlier. We have selective credit control as the first one. All right, so in this particular item, we are talking about higher purchase and also loans. So actually, when they select, okay, they have to control, okay, for certain credits given by the public, by the banks or even depository institution, okay, to the people or even to the public. So it must be very selective. Okay, maybe, okay, what banks can do, they can allow loans only for productive purposes. Okay, how to allow loans for public productive purposes by increasing minimum margin requirements, for example, to open a letter of credit, or even by imposing tighter hire purchase regulation. Okay, by fixing minimum down payment, and also maybe they actually fixing the maximum repayment period. So they say, if let's say public, okay, wanted to do loans, okay, from the depository institution or even banks, okay, they have to actually put it over there, what kind of purposes that they wanted to do this loan. Okay, so only for productive, then only the loan can be released. Or even maybe they say, okay, there must be certain down payment, all right, that public need to do, or even companies need to do. All right, so that would be number one. Okay, the second tools, we call this as a moral suasion. Moral suasion, something to do with the restriction of the lending policies, okay, by the commercial banks. So commercial bank actually can restrict, okay, their lending policies in order to reduce the demand from the people regarding the loans. All right, finally, we have special directive. This is something to do, okay, by the central bank, in which central bank might actually instruct commercial bank to reduce the volume of loans given to the public. Okay, instead of giving, for example, like 100,000, maybe maximum only 50,000, something like that. All right. Okay, so I already covered about quantitative and also qualitative tools. Okay, so now we look into those two kinds of situation, all right, that normally facing by countries in the world. All right, so currently, as Dr. Dima said just now, most of the countries in the world, okay, especially Malaysia as well, facing with this inflation problem. Okay, facing with this inflation problem. I think this is maybe due to the pandemic COVID. Okay, as what has been apa tu kita lalui kan for the last, I mean, for the last 2 years. Okay, so in order to combat this problem, all right, so definitely central bank can apply this monetary policy. Okay, can apply this monetary policy. When we talk again about monetary policy, we are talking about money supply. Okay, we are talking about money supply. So during inflation, okay, purchasing power of the people increase. That's why most of these goods and price for goods and services has been increasing as well. All right. If you learn about inflation in microeconomics, all right, in microeconomics, they are talking about types of inflation, or even why actually inflation happen. It can be due to cost push inflation, okay, and so on and so forth. All right. So during inflation, what happened is government definitely will instruct central bank to reduce the money supply. Okay, to reduce the money supply. All right. So how to reduce money supply? As I mentioned earlier, there are actually 5 tools, okay, to be implemented under quantitative measures. All right. The first one is open market operation. So when we talk about open market operation, we are talking about selling of the short-term bonds. Okay. So why actually central bank can sell these short-term bonds? Okay, by selling these short-term bonds in the open market, actually central bank can influence the size of the bank deposits. Okay, so central bank actually will reduce the cash reserve of commercial bank. So when central bank reduce the cash reserve of commercial banks, so commercial banks actually will giving out less loan to the people or even to the public. Okay, so when they are selling these short-term bonds, what happened is commercial bank, okay, or even private individuals and also non-bank public will buy these bills. Okay, so checks are payable to the central bank with less cash reserve. So when this commercial bank having less cash reserve, bank actually will be selective in giving out loans. So this will affect purchasing activities of the people. All right. So at the same time, what happened is general price level will be reducing. All right. So by applying these kind of tools, okay, what happened is inflation can be reduced because general price levels of all goods and services can be reduced as well, in which purchasing power of the people will be reduced as well. Right. So that will be the first one. Okay. Second, as I mentioned earlier regarding reserve requirement rates. So as what everybody know just now, reserve requirement will be, okay, the requirement, all right, that actually central bank, okay, will pursue this particular commercial bank or even depository institution, okay, to save or even reserve, okay, some amount of money in central bank. So during inflation, what actually central bank will do? Central bank actually will increase the reserve requirement rates. So when this happened to be, the reserve requirement ratio has been increased. So the ability of the banks to provide loans to the public will be reduced because they have to save more. Okay, they have to reserve more. Okay, the money in the central bank. Okay, so the reserve that they have, or what we call that as an excess reserve, that this depository institution or even the banks have will be reduced. So this actually will make this depository institution provide less loan to the public. Okay, so with less excess reserve, bank will be selective in giving out the loans. So what happened is this will affect the purchasing activities of the people, and also at the same time the price level, general price level of all goods and services will be reduced. So actually inflation can be controlled in that particular country. Okay, all right, so that will be the second dose. Very simple actually. Once you know uh what happened, what actually central bank will do during inflation. Okay, when you know about these five kind of tools under quantitative measures, we can actually apply for recession or even unemployment problem as well. Okay, but the other way around, instead of like open market operation selling the short term bonds, okay, during recession or even unemployment, this actually central bank will or even may purchase the short term bonds, maybe the other around. Same thing happened to the second tools just now. Okay, instead of increasing the reserve requirements during inflation, okay, but during what we call that as recession or unemployment, this actually central bank can reduce the reserve requirements. Right, the same thing actually apply the other way around. Okay, number three, okay, the third tools, we call this as discount rate. As I mentioned earlier, when we talk about discount rate, this is actually the interest rate charged by the central bank, okay, to the other depository institution or even to the banks. So definitely, in order to reduce, okay, the purchasing activities, okay, or even to reduce the general price level, okay, or even in order to reduce the amount of loan giving out, okay, by the banks to the public, definitely discount rate will be increased. Okay, central bank will increase the discount rate to be charged to the banks. Okay, so actually central bank is the lender of the last resort. Okay, instead of actually um, making a loans from the central bank, these actually depository institution, they can make a loan among themselves as well. Okay, from the other banks as well. Okay, so when the other banks charge the interest rate to the other banks, we call that interest rate as federal fund rates. Okay, we call that as a federal fund rate. We do not call this as a discount rate. Discount rate is only the interest rate charged by the central bank to the other banks. All right, so if let's say commercial bank are short of liquid assets, definitely they can actually make a loan from the central bank. All right. So when they are forced to borrow from the central bank actually can choose whatever rate that they want. Okay, they can actually increase the interest rate or even reduce the discount rate. But again, it depends on what kind of situation that actually the country faced with. All right. So a rise in the discount rate actually rises the price of the borrowing funds, in which, okay, if let's say previous year is about 5%, okay, now uh, the central bank decide to increase it into 7%. So definitely the borrowing of funds and the price of borrowing funds will be increased. Okay, so borrowing funds become more expensive. Okay, definitely demand for loans will be reduced. So when demand for loan will be reduced, definitely, okay, we can combat the problem of inflation because purchasing activities can be reduced. All right, and this automatically will reduce the general price levels of the country as well. All right, so that will be the third tools. Okay, and the fourth one, we call this as interest rate policy. As I mentioned earlier, interest rate policy actually refer to the interest rate charge, okay, by the banks to the public. So again, all right, central bank actually will persuade, okay, these banks or even depository institution to increase the interest rate. All right, to increase the interest rate. So when interest rate has been increased, okay, so this level of saving of the people also will be increased, and they actually demand for loan less because they have to pay more, okay, for the borrowing of the funds. All right, so this will reduce the total of demand for money. All right, and also purchasing activities. All right, okay, that will be number 4. And finally, we have funding. Okay, funding actually selling the long-term bonds, okay, during inflation and also lengthen the payment of the principal sum. Okay, so in this case, when we talk about successful funding, we are talking about people buy liquid securities, which causes a fall in the general public's expenditure. So when general public's expenditure reduce, okay, and also money supply has been reduced, so inflation rate can be reduced as well because public will reduce their demand for money and also purchasing activities will be reduced. All right, so this is all the 5 tools that will be used, okay, for monetary policy, all right, during inflation. Okay, let's look into the next one. Okay, I think the next one is relate to qualitative measures. Okay, can we look into qualitative measures? Yes. Okay. This one. Okay, so during inflation, for qualitative measures, okay, as what we have discussed earlier, okay, we have 3 tools. Okay, number 1 is selective credit control. So definitely everything must be tightened, okay, during inflation. So higher purchase. So what happened to higher purchase? Banking system will fix regulation for minimum down payment, all right, and maximum repaying period. Okay, and capital issues control, in which central bank will issue directive to banks to give loans only, as I mentioned earlier, to productive purposes only, okay, and not to speculative or even unproductive purposes, right? Okay, for moral situation, what central bank will do? Central bank actually will persuade commercial bank to restrict their lending policies. All right, so this is during inflation. Okay, but definitely during recession, if we talk about moral situation, central bank actually we persuade commercial bank to make it a little bit flexible, okay, regarding their lending policies. Okay, finally, the third tools we call this as special directive. So what actually central bank will do? Central bank will actually can or even set up directive and instruction to bank to reduce the volume of loans given to the clients. Okay, maybe last time can give about 500,000, now maximum only 250,000, for example. All right. All right, so that's about inflation. Okay, let's move into the other kind of situation, all right, in which when countries facing with these and unemployment problem or even recession. Okay, when we talk about unemployment, I think everybody should know what does it means by unemployment. Unemployment actually refer to the people who are not working or even who are unemployed, but they are actively seeking for a job. Okay, actively seeking for a job, but they couldn't find one. So we call this as unemployment. So again, we have two kind of measures. Okay, similar like inflation just now. Okay, we have quantitative and also qualitative measures, right? So as we have discussed earlier, we have 5 tools under quantitative measures. Okay, let's look into the first one, open market operation. Okay, so to increase the people to be employed, okay, or even to reduce the unemployment problem. Okay, so central bank actually will buy the short-term bonds from the public. Okay, when central bank buying these short-term bonds from the public, so this actually will increase purchasing power of the people. Okay, so when their purchasing power increase, they will actually spend more. Okay, so when they spend more, this actually will increase the demand, okay, from the people, and this actually will create more job opportunities. Okay, when more job opportunities has been created, all right, so people actually can work in the industries, okay, manufacturing sectors and so on and so forth. So this actually automatically will reduce the unemployment rate. All right, so that will be the first one. Okay, second one, what happened to the reserve requirement rate? If during inflation just now, all right, a central bank will increase the reserve requirement rate because they wanted actually to reduce, okay, the power of giving out loan to the people. Okay, but in this particular situation, to increase the employment or even to reduce the unemployment problem, central bank actually will lower, or what we call that as reduce, okay, the reserve requirement rate. All right, so when the reserve requirement rate has been reduced, maybe previously 7%, now a central bank said okay, it has been reduced to 5%. So what happened? All right, the excess reserve, okay, in the bank itself will be increased. When excess reserve in the bank itself increase, so this will increase actually the bank's ability, okay, to create credit. Okay, the bank ability to create the credit by giving out more loans to the people. All right, so this will encourage the bank to offer more loans to the public and also businessmen. All right, so this actually will create more job opportunities to the public. All right, so unemployment problem can be reduced. Right, so that would be number 2. Let's move into the third tools. What do we have under number 3? Okay, number 3, yes, we having this funding. Okay, funding. Just now when we talk about funding, we are talking about selling or even buying, okay, the bonds. All right, so for this unemployment, during unemployment, uh, definitely will buy long-term bonds, similar like OMO just now, open market operation. Okay, buying the securities. All right, this is buying the long-term loans. All right, when buying long-term loans happen to be, so this will shorten the duration of time for loan repayment. So this will allow them to increase the volume of loans. So when allow them to increase the volume of loans, meaning to say public, okay, or even household, all right, they can actually get more loans from the bank. So this will increase their purchasing activities, all right, will create more job opportunities. So at the same time, will reduce the unemployment problem. Okay, and number 4, we call this as a discount rate, or what I mentioned earlier, bank rate. Okay, so you have learned just now, during inflation, definitely bank rate or even discount rate will be increased. Okay, but to combat the problem of unemployment, all right, central bank actually will reduce the bank rate. Uh, so when bank rate has been reduced, okay, definitely these depository institution, all right, they have more opportunities actually to make higher loans, okay, from the central bank. Okay, and demand for loans will be increased. So this will affect all the other rates in the market to allow more circulation of money in the economy. Okay, so when they can get more loans from the central bank, they are giving out more loans to the public. All right, so this will create job opportunities as well to the people. Okay, finally, we have the interest rate policy. As I mentioned earlier, this is the rate charged by the banks to the public, or even to the to the public. Sorry, to the public. Yeah. So during unemployment problem, definitely, central bank will persuade commercial bank to reduce their interest rate. So when they reduce their interest rate, okay, the level of demand for money will be increased. Okay, so the cost of credit to the public will be reduced. All right, so this will increase the level demand of money and also purchasing activities of the people. So this actually will lead to the reducing in the problem of unemployment. All right, so very simple. If you know just now inflation, recession or unemployment will be the other way around. Okay, so you just remember during inflation, everything will be increased. Okay, interest rate increase, bank rate increase, reserve requirement rate increase. Okay, and for this particular recession or even unemployment, everything must be reduced. Reducing in terms of bank rate, reduction in terms of interest rate, all right, and also reduce in terms of percentage of the reserve requirement. Okay, and I think we have qualitative tools also, right? There are 3 tools to be used or even to be implemented during unemployment, all right, or even during recession. Okay, so very short, qualitative, allowing and supporting the banks and financial institution to advance credit to household, okay, as well as firms for productive and also non-productive purposes. So they don't have any restriction, all right, for qualitative measures in terms of giving out loan to the public. All right, so they are very become more flexible, all right, in order to reduce this problem of recession or even unemployment. Okay, so this is all the tools that actually central bank can use or even can implement, all right, when countries facing with this kind of problem. So as what we are facing now, okay, most in most of the world, most of the countries facing with the inflation, so those kind of tools actually can be implemented by the government or even by the central bank in order to reduce the problem of inflation. All right. So this is the ones that I said just now as what we have discussed just now. All right. This is a summary. All right. So that one maybe you can have a look later. All right. Let's move into the goals of monetary policy. There are actually 5 goals, okay, of monetary policy. So this is objective of implementing or even having this kind of monetary policy by our government. All right. Why actually government having this kind of monetary policy? Actually, we have another types of policy. We have fiscal policy as well. Okay. But when we talk about money supply, we are talking about monetary policy only. When we talk about fiscal policy, that will be the other kind of policy that normally can be implemented also by our government, but that one actually related to government expenses as well as government revenue. When we talk about government expenses, we are talking about government expenditure. When we talk about government revenue, we are talking about taxes, because the main actually revenue come from taxes, okay, from most of the countries. All right, so fiscal policy, I don't know whether this particular subject, monetary economics, for our university at UITM, we cover a little bit about fiscal policy, but that one is under ISLM model. Okay, when we talk about investment saving and also liquidity money framework. All right. For this particular topic, I only covered this one, monetary policy. All right. So the goals or even the objective of monetary policy, the first one, definitely the primary goal to stabilize the price of all goods and services. All right. Number two, all right, to have high employment or even to stable the output. All right. Or even the income. Okay, and then number three, definitely economic growth. Okay, they are actually wanted, or even countries wanted to achieve stable or even a high economic growth. Number four, stability in terms of interest rate. Okay, and the last one, in terms of financial market, also they want to have a stabilize of financial markets. All right. I think that's all. But actually, I don't know whether Dr. Dimas, I should cover regarding uh, a demand curve for reserve, supply curve or for reserve or not.
I guess enough, doctors, for a while. I guess you have covered so many issues here. The framework of the monetary policy has been discussed in details. The
Yeah,
instruments, also the objective, yeah, also
yeah.
the instrument, and so forth. So I guess all of you have already covered all the things. So
Okay.
I guess we move to the Q&A sessions. Perhaps our
Yeah,
students or our participant here have some questions or some comments, doctors.
yeah, yeah. Any question from the
Yes.
floor?
Okay,
Anything
doctors.
that you cannot understand?
Doctors, by the way, your presentation just now, if I go through from the beginning until the end, you cover so many details, information about the current issues regarding with the
Yeah.
inflations, interest
Uh-uh.
rate, and very much relevant with the situation faced by our central banks.
Yeah,
I
correct.
just have a humble, need your humble response, doctors. You see that some countries that they try to follow the conventional monetary policy. It means that they have to increase the interest rate in the mid of the inflations. But some of the countries we found that they are conducting the anti policy or unusual monetary policy response. For example, in Turkey, if you remember, the central bank not increasing the interest rate, but they reduce the interest rate closer to the zero, doctors. So based on your first observation, doctors, why these different countries, they have their own different response in the monetary policy? Do you have any observation on that, doctors?
Monetary policy, suppose, as what I mentioned earlier, conventional, they have to follow. Okay, during inflation, they have to increase the interest rate, but then during a recession, they have to reduce their inflation rate. Okay, but maybe it depends on the country itself. Again, maybe they are looking into the reserve that actually the bank have. Okay, if let's say they have more reserve, okay, they have more reserve in which they think that they can combat their inflation. All right, that's why they are actually, as what you mentioned earlier, like Turkey, they are reducing their inflation rate up to zero. It could be that kind of situation also, Dr. Dimas. What is your
Okay,
opinion,
doctors.
Dr. Dimas?
Yeah, because this one becomes
like
interesting
like very
issues.
weird, right? Like very weird things, huh? Why actually they are doing
Yes.
those kind of things?
Yes, doctors. Because I guess that they um, try to water the real sectors, doctors, perhaps.
Yes, yes, yes.
Given that this economy, Turkey's economy depends on the tourism, for example. So
Yeah,
by having this lower of the interest rate, the foreign people that coming to Turkey feels that the money that they handing is very cheap
yes,
in terms of the liras Turkish, for example. So that once they came to Turkey and they can exchange the money very much cheaper compared to the another currency. So hopefully it can be used for transaction, doctors.
Yeah,
So
they are giving
hopefully,
actually more convenient to the foreign people actually that coming to their
right,
countries
right,
as well.
right, right. And also perhaps the Turkey tries to push the flows of the goods and services.
Correct, correct.
Because by lowering the interest rate, the entrepreneurs, the private sectors, they can easily borrow and lend the money, doctor, so that hopefully
Mm-mm.
it can improve the goods and services in the economy,
Correct.
even though the inflation in the country quite high,
Yeah, still
doctor.
facing
Uh,
high inflation.
yes, doctors. Okay, doctors. There is one question from our students. Hello, Isha. Isha, are you with me? Isha, Isato, Aisha, are you there?
Yes, yes.
Could you please ask your question directly to Dr. Halima, please? Aisha, could turn on your camera so everybody here knows about you, please? Aisha. Aisha here, a student from Gambia, Dr. Halimah, by the way.
Oh, okay. You have
Full-time
many
student.
foreigner students, right, Dr. Dimas?
Yes, from Gambia. Yes,
So
Gambia,
I have
Bangladesh.
a
We have
question.
also from Somalia.
Oh,
Yeah.
good, good.
Okay, please. Yeah. Time is yours, Isha, to ask the questions.
Sorry for opening my camera. I was having a class. So my name is Aisha, and I am from the Gambia, currently studying IPF. I wanted to ask about monetary policy. Talking about monetary policy, is it that the government is always responsible for the monetary policy, or there are other agencies or organizations?
I can't get what actually you.
Her question actually was written in the chat, doctors.
Okay, okay. Let me
Government
check.
is always
Yeah.
responsible
Check.
about it, or there are other organizations or other agencies handling about the monetary policy in a particular state or country.
What happens if monetary policy is loose? What do you mean by monetary policy is loose, Isha?
Perhaps, doctors, if I'm not mistaken, her
Mm-hmm.
understanding is somehow the government failed to guide the monetary policy uh, to be credible, to be maintaining the inflation rate, for example. So, is there any other institution other than central banks that can perhaps back up the failure of the central banks? Maybe this is the meaning of her questions, doctor.
Okay, if let's say, in my opinion, if let's say monetary policy has been failed, okay, it being implemented by the central bank, okay, what happened is, as I mentioned earlier, there are actually another policy that actually government can do, or even government can implement. Okay, so government actually can implement another kind of policy in which we call that as a fiscal policy. Okay, in which government either can increase their revenue or even increase their government expenditure. All right, so through this particular situation, if let's say a country facing with this kind of inflation, all right, in which purchasing power of the people has been increased, okay, so what actually government will do is government will actually using this fiscal policy by increasing the government revenue. How to increase the government revenue? Government will increase the taxes. Okay, so when government increase the taxes, meaning to say public, okay, will pay more taxes to the government, or even companies will pay more taxes to the government. All right. So when they are paying more taxes to the government, all right, in this case, okay, purchasing power of the people will be reduced. All right, and also purchasing activities will be reduced. Okay, in which this inflation can be combat as well.
Yes, correctly mentioned, doctors. So, Aisha, have your question been answered?
Yeah, the question is answered, but I have another question.
Please.
We all know that the main target of monetary policy is to control inflation. So what happens if what happens when monetary policy is lost?
What does it mean by the loss? It cannot control the inflation, you mean, Aisha?
What?
The loss of monetary policy means the central bank cannot control the inflation. It does mean by your question, Isha?
Fail lah. I mean, maybe she means
Yeah.
by fail to implement the
Yes, yes.
Exactly.
monetary
I
policy.
mean, what if the monetary policy fails? What is the role of
Y-
the government? What will they do?
Yes, yes, yes. I get your question. So, what will be how is the responsible of the government, Dr. Halimah? He does mean like that. Once the monetary policy failed to control the inflations, to what extent the responsibility of the government or the central banks if they fail to control and maintain the inflation rate as targeted?
Okay. What actually government can do is, as I mentioned earlier, government actually they can what I mentioned earlier as they can actually implement this fiscal policy, okay, or even this particular government they can control more areas of the market, okay, control the price of the goods and services, all right, in which maybe they can setting certain price floor or even price ceiling, okay, for all the goods and services, all right, in order to control this inflation. Because if let's say the monetary policy has been failed.
Okay, Isha, maybe I can add up just a bit about doctor's answer just now. So you see that in the context of Indonesia, Aisha, we have a Financial System Stability Board. So it consists of central banks, financial services authority, depository institutions, and also the Ministry of Finance. So all of these institutions are responsible for maintaining the financial system stability, whereby inside the financial system here is the controlling inflation. So in that positions, if the central bank fails or cannot control the inflation, then the government will take some another response. For
Yeah.
example, the government will have will promote the fiscal policy to do more functions, because in reality, monetary and fiscal policy are complementing each other. Yeah, so they are running together because the fiscal will responsible to the real sectors, and the monetary policy will be responsible to the monetary aspects. So real sectors and monetary sectors here are part and parcel to be integrated, to be maintained. And the measurement to measure this one is the inflation rate. So by that facts, Aisha, I guess the failure of the government is not the failure because of their fault. You have to understand that in Indonesia or in Malaysia or in your country, we are small and open economy, by the way. So the small open economy have the impact that our country is very easy to be affected by the shocks, external shocks. So the fluctuation of inflation, what exchange rate and whatever, is not due to only our domestic failure or domestic instability or domestic activities, but also because of the external or international activities. So therefore, in the context of the governments, I guess in Malaysia as well has been implemented, we have the macro prudential policy and the micro prudential policies. So these policies are responsible to maintain the vulnerability of the institution as well as the shocks, yeah, that coming from the financial system. So in the end of the day, the government, the central bank in particular, will be trying the best to maintain the system that based on the macro and micro prudential policies. That one, Aisha, perhaps just add a bit from the doctor's answers.
Yeah, actually, what government actually can do also, added with what actually Dr. Dima say, all right, implement the fiscal policies, all right, and so on and so forth. maybe government also can intervene, okay, in this particular situation, all right, by fixing the taxes, okay, subsidies, okay, impose certain law and regulations, okay, and so on and so forth. All right. So introduction of government activities such as government adjust the taxes, okay, tax adjustment, okay, and then subsidies adjustment, okay, and also impose certain rules and regulation. All right. Okay, Aisha.
Okay, Isha, I hope your answer has been answered. If you feel that you are unsatisfied, you can ask to you can questions during the class, perhaps
Okay.
during the your offline class. Okay, another question perhaps from the audience, please, or maybe the question through the chat if you don't feel or inconvenient to ask directly question to doctors. Brother Ridwan, are you going to ask questions? I saw you just now raise hand. Brother Ridwan?
Ridwan from which country? Indonesia.
I'm
Yes,
from
Indonesia. Ridwan, you have any
Okay.
question? I guess you raise a question just now. Raise hands. Ridwan, please.
Pak, saya pakai bahasa Indonesia ya, Pak.
Oh yes, please. You can use Indonesia or Malay.
I'm sorry.
Ya, boleh.
Boleh,
Bu,
sila.
dan Pak Dimas mau bertanya, kalau semisalnya satu negara itu seperti negara bangkrut loh, seperti kayak negara-negara yang memiliki inflasi gitu. Itu kan negara itu kan udah parah tuh, Pak. Apakah mereka bisa menjadi pulih, Pak? Dan bagaimana caranya negara itu bisa pulih dengan melakukan regulasi apa, Pak? Apakah menggunakan regulasi moneter atau pakai yang satunya, Pak?
Fiskal.
Terima kasih. Fiskal. Terima kasih.
Doctors. Can you understand the question, doctors, using bahasa Indonesia?
I think he asked regarding whether government should implement either monetary policy or fiscal policy if, let's say, a country facing with inflation. Is it?
Yes.
So actually, as I mentioned earlier, what is his name just now?
Ridwan.
Ridwan. Okay. Boleh difaham ke kalau saya cakap in English? Can understand or saya
Yes.
nak cakap bahasa Melayu?
Paham, Bu.
Boleh ya? Okay. So, if let's say a country facing with this kind of inflation or even the other way around, recession or unemployment problem, what government will do first, they will implement the monetary policy first. Okay, they will try to implement the monetary policy first because this monetary policy is generally about something to do with the banking system. Okay, something to do with the banking system, in which this banking system actually will affect, okay, the whole country's financial situation. All right, in which either they will increase the bank rate or even reduce the bank rate, increase the interest rate or even reduce the bank rate, interest rate. These actually will directly affect the companies, big companies, okay, as well as manufacturing companies, as well as the household as well. All right. So first, definitely government will deal with this central bank to implement the monetary policy by increasing the money supply or reducing the money supply. If let's say, okay, this monetary policy has not been success, as what Aisha said just now, if let's say failure in terms of monetary policy, then government will take another, will try to implement another policy by implementing the fiscal policy to increase government revenue or even increase government expenditure, or maybe reduce the government revenue or reducing the government expenditure. All right, in order to combat this kind of problem that faced by the country. All right, so when they are taking into accounts, okay, this kind of, or even when they measure this kind of fiscal policy, as I mentioned earlier, all right, government also at the same time, okay, implement certain rules and regulation or even laws, okay, and also something to do with the taxes, all right, increasing the taxes or even something to do with the subsidies. So again, when they are talking about rules and regulation or even laws enforced, okay, by the government, or even they are doing something with the taxes or even with the subsidies, this actually automatically falls under fiscal policy. Okay, Ridwan, is it okay?
Sudah, terima
Am I
kasih.
answering you? Boleh kah? Saya dah jawab tak persoalan tu tadi?
Sudah, Bu, terima kasih.
Sudah ya. Alright. Okay.
Okay, Dr. Halima, I guess the
Okay.
discussion is very interesting and interactive. Yeah, but the time has been closer to the
Yeah.
closer to the
Okay.
end. Yeah. So actually, perhaps you want to say something else, Doctor, as the closing remarks?
This student is actually which semester, Dr. Dimas?
The fifth semester.
Fifth semester, they are actually under degree of degree of what?
Economics.
Degree in
Economics.
economics and business, is it?
Right, Doctor.
Oh, so they supposed to graduate in semester 6
Yes, next year, inshallah.
next year, inshallah. So just want to wish to all of you, good luck to all of you. All right, and you are very lucky to get Dr. Dimas as your lecturer or even maybe your supervisor. Okay, in future, if let's say they wanted to pursue master, Dr. Dimas, all right, you have master in economics at your university as well.
Now we are still in the process of establishing, Doctor, this year.
Oh,
Master of
so for the
Economics.
time being, you only have degree students.
Yes.
PhD? Do you have any PhD students currently there?
No PhD students so far.
Oh, no PhD students so far. So you are not supervising any PhD students for the time being?
No, Doctor.
Oh, okay. Inshallah. Okay. In future, all right. If let's say the university, having this kind of program, master program, or even a PhD students, a PhD program, is actually a good for the students. Okay, especially for those degree students, maybe you can plan for your future what you are going to do. Okay, with this kind of situation, pandemic, COVID-19 situation, we already actually facing with this pandemic COVID for 2 years. And I think now is quite stable already, in which we already have face-to-face classes, okay, less online classes. So again, wish you good luck and for your future undertakings. Okay.
Okay, Dr. Sahalima, terima kasih. Thank you so much for the time given to us in the very early morning. Given that our class started since 7 a.m. In the morning.
7 a.m. started already class,
yes,
Dr.
7
Dimas?
a.m. or 8 p.m. in Malaysian time, and will be ended. We have also night class around until 9 p.m. in the evening.
Wow.
Yeah. Yes, because the student numbers is quite many
Big.
doctors, so that we have to have a schedule until evening. Yeah,
Wow.
but no worries, doctors. We try to combine with the LMS. By the way, thank you
Okay.
so much, Dr. Halima, for the time.
All
So
right.
students, I wish that you have already got some very complete and also details in interaction with her about monetary policy. And if I may conclude a bit, that monetary policy, by the way, is just instruments how to maintain or to reach the goals, namely the stable and lower inflations. And this goals not only just a responsibility of the central banks or the monetary policy, but it must be combined by the fiscal policy or the governments. So those two institutions will be part and parcel that will be coordinating each other, so that these goals will be sustained, will be in the long run will be maintained and sustained. For sure, it must be guided by the prudential policy called macro and micro prudential. And
Correct.
for sure, these activities, this inflation also influenced by the international shocks. Yeah, that's why the government tries to discuss and coordinate intensively with not only by in the domestic side but also for in the international institutions. With that, I close these sessions by reciting Hamdalah together. Alhamdulillah Rabbil
Enough.
Alamin. Once again, terima kasih Dr. Halimah. Stay
You
safe
are
and
most
health.
welcome.
And see you inshallah next time for the another
InsyaAllah, Dr.
reciprocal activity.
Dimas.
Yeah, and send our warm regards to the deans, also the head departments, and hopefully we can meet physically at UITM or in UMY.
InsyaAllah.
Yeah. Okay. Okay. Thank you so much, doctors.
Alright.
Wassalamualaikum warahmatullahi
Waalaikumsalam.
wabarakatuh.
Bye.
Waalaikumsalam. Terima kasih Bu. Pak.
Pak Dimas. Maaf Pak,